Here we go again. Just a few weeks ago, every investment bank was calling for a major rally in 2025. They were talking about double-digit gains, a booming market and great opportunities to buy. But then, boom, one bad week and the S&P drops by roughly 5%. Suddenly, the very same banks warn about potential risks, uncertainty, and potential further downside. Frankly speaking, I was puzzled and astonished about this drastic change in their positions. So I stopped for 1 second and asked myself, did the entire economic outlook change in just 5 working days? Did company suddenly become less valuable? Or there is something else going on? Maybe. Before diving into the topic and know the answer, don't forget to subscribe to the channel, leave a like and share this content to help me grow in the community. And now, let's get started. Let's get one thing straight. Investment banks are not in the business of helping you making money. They are in the business of making money themselves. And this is clear. And how do they do that? By generating trading volumes. Every buy order and every sell order is a commission that flows directly into their pocket, meaning that it goes out from your pocket. Long story short, the more the market activity, the more they profit. And guess what drives market volatility? Fear and greed, as we spoke in one of our last videos. Link in the description down below, if you would like to refresh your memory. This is why banks constantly flip their narratives. One day they sell you on the greatest opportunity of the decade, the next they warn you about elevated risks and overvaluation concerns. The thing I would like you to understand is that it is not about accuracy. It's about keeping you engaged, keeping you buying, selling and reacting. Because the more volatile the market, the more money they make. Charlie Munger, that is in my top tier list of investors, once said, people who know nothing about stocks can make a lot of money if they reduce the transaction. And this is absolutely true. That's the point. If you are constantly buying and selling based on these calls, you are playing the investment bank's game and not yours. Now, just to frame this a bit, we can say that it is not about the market outlook as a whole, but it goes beyond. And the same game applies to individual stocks, maybe even more so. Because if you think about it, the volatility impacting one single company, looking at the indices, it is all in all diluted. So in substance, it is way easier for banks to keep you engaged looking at one single corporation at once, bringing you down to the news watcher trading bias, as it is called in behavioral finance. Just to make a quick example, S&P 500 dropped 5% in 5 working days, while Tesla dropped by around 15-20%. So a tremendous volatility impacting one single company. And Tesla was just one of the many. The entire tech sector was under pressure, let's say. And in this regards, I have a question that I would like to ask you. Ever notice how target prices are constantly changing? One day one stock is overvalued, then suddenly is undervalued at the same price. That's because target prices are not real valuations. They are stories meant to trigger action. And one of the greatest investors of all time put it perfectly. And I'm talking about Peter Lynch. Far more money has been lost by investors preparing for correction or trying to anticipate corrections that has been lost in the correction themselves. And this is brilliant, because the real money is made by ignoring the noise and focusing on the long-term potential, so looking at the fundamentals. So, what do the legends of investing actually do? First of all, they do not listen to those headlines. They run their research and take decisions based on the numbers and on the real story of the company, notably its earning generation potential, long story short. And in this light, Warren Buffett, who outperformed the market for decades, give us a really serious pearl of wisdom that everybody can understand. That the stock market is designed to transfer money from the active to the patient. He doesn't chase market calls then. He doesn't panic when investment banks flip-flop. He invests in great businesses and let the time do the work. So next time you see investment banks flipping their forecast overnight, ask yourself, are they helping me or they are just playing the game that makes them rich? Because from my personal perspective, if in this market you constantly listen to their calls and react, you are not the customer, you are the product, a living ATM. Now guys, before saying goodbye, let me know what you think in the comments down below and tell me if you ever follow an analyst call that turned out completely wrong. And don't forget to like and subscribe for more content like this one. See you in the next one. Cheers!